Clubbing and aggregation of income, section 60 to 65. Income of other person including in the total income of the assessee. Generally, a person is liable to pay tax on his or own income, but in some special cases the assessee is liable to pay tax on the income of other persons. So here the transfer of income without transfer of the asset, section 60. If a person transfer the income generated from an asset without transferring the asset for without an adequate consideration, then he is liable to pay tax on the transferred income. If the following conditions are satisfied, then only the clubbing of income is possible. Number 1, the assessee is residential status is resident. The assessee is the owner of the asset and the income generated or received from the asset is transferred to other person. For example, Mr. Raju is the owner of a building and he let out his building to the residential purpose. Under the agreement to the tenant, he has instructed to pay the rent to his niece Srimati Srevanti. But Mr. Raju is liable to pay tax on the house property because it is only a transfer of income and not to the transfer of the source. And if any person makes a revocable transfer of asset, section 61, if any person makes a revocable transfer of an asset to the owner or a person under a contract, then the income arising from such asset will be taxed in the hands of transferor. If any asset is transferred with a condition that after some time from the death of transfer of either during the lifetime of a transfer or the transfer of an agreement to a transfer comes to an end automatically. For example, Mr. Beam transferred a residential house to his friend Mr. Arjun with a condition that after the death of Mr. Arjun, the ownership of the house will be transferred to his brother Mr. Dharmesan. And income of a minor, section 64 1a. Income of a minor child shall be clubbed with the income of his parents. The income of a minor child will be included in the income of his father or mother whose income is higher. If the parents are not alive, then the guardian of the minor is liable to pay tax on the income of the minor child. Income of the spouse, section 64. The relationship of an husband and wife should be there at the time of transfer of an asset or income. That is, the transfer of an asset before the marriage is outside the spouse of this section. Similarly, the transfer of husband or wife dies, then the provisions will be clubbing will not arise. The surviving person has to pay the tax on his or own income. Situation 1. If the income of a spouse as a remuneration, section 64 1-2, if the spouse is received the remuneration for the services rendered as a technician or a profession, the person then clubbing provision will not be possible if the spouse is personally liable to pay tax on his income. Situation 2. If the income for the asset is transferred to the spouse, section 64 1-4. If any asset other than the house property is transferred to the spouse, then the income from such asset is clubbed with the income of the assessee on satisfying the following conditions. Number 1, the transfer is made without the transfer and adequate consideration. The husband and wife are living together. The asset is held by the assessee or a spouse. In the cash is gifted by a spouse. She deposited in a bank, then the interest on bank deposit is taxable as in the case of assessees. Pin money. If any money given by the husband to wife to meet her personal expenses or for the domestic expenses, then such money is known as pin money. In this case, this income cannot be clubbed with the income of the husband. An asset transferred to the spouse or a minor child, section 64 1-4. If an individual has transferred certain asset of the spouse or a minor child, income arising from such asset is taxable in the hands of transferor. And transfer of an asset to a daughter-in-law and the grandchild, and these incomes are going to be clubbed with the income of the assessee. The transfer of a property by any member or Hindu undivided family, actually the Hindu undivided family, the karta is going to be liable to pay tax and the members are going to be, the portion is be given to the co-partners and the person is going to be paid to the tax. And binomy transactions, if a transaction is effected only on a paper and the transfer of enjoys all the rights, benefits, etc. In in such transaction is known as binomy transaction. Example, Mr. Govardhan is owner of a business. He purchased a building on his employee's name, Mr. Kapil, but rent of the house is enjoyed by Mr. Govardhan or his family members. So such income shall be taxed in the name of the Govardhan only, but not in the name of Kapil, as is called as a binomy dor.